On behalf of the Business Centre, I'd like to welcome everyone here to this Business Fusion event. The Business Centre would like to acknowledge the traditional custodians of these lands upon which we meet and show our respects to Elders past, present and emerging, and again welcome everyone here to this place. This month's Business Fusion event is all about financials, and it's a topic that puts a lot of people to sleep, sometimes myself included. But we're going to try and demystify some of the terms that are often used in looking at a business's financial reports, how those reports are generated and what the numbers actually mean. We're going to do that by way of an interactive spreadsheet tool, which we'll work through together a little bit later on. For those of you that don't know me, my name's Peter Hollingsworth. I'm a business advisor, trainer and mentor here at the Business Centre. And I've been around the place for quite some time, but the Business Centre itself has been around for about 37 years. Our purpose in life is to assist businesses and thereby assist our community to remain vibrant, to remain current, to remain educated, skilled, and the necessary cog in the wheel of our community. Today's event is brought to you by Service New South Wales, the New South Wales Government's Business Connect program. Business Connect provides free, independent, tailored business advice from experienced advisors in one-on-one sessions. We offer practical insights and business skills, and our services include events, resources, education, and all about a range of topics for small businesses. So with no further ado, I might just jump into the content. So tonight I'm just going to be speaking over and navigating around a series of linked spreadsheets. These spreadsheets have been developed by ourselves and are freely available to clients of the Business Connect program who seek an advisory session with us. And I'll give you a quick overview of how the spreadsheets work, but they're all about tracking and understanding where the costs are in any business, where your revenue streams come from, how that information is played out in terms of a sales mix summary and a cash flow forecast, and how we might generate some financial reporting tools from that information. And for those of you who might be in a varied range of industries, I've tried to pick something that we can all relate to illustrate and develop as we go through. And if you can imagine a small suburban cafe is going to be the model I'm going to use, where we've got a range of different products and services on offer, a range of typical business expenses, and we're going to try and do some forecasting to understand how all these numbers come together and what sense we can make of the financial reports that we're able to approximate going forward. In reality, of course, in your own business, you will have your actual generated data from your accounting package. So we're starting with a forecast that's going to try and estimate or preempt that, and then do some analysis as we go through. To show you the spreadsheet tool, there's a series of linked spreadsheets that are on the screen there now, and you can access each by clicking the tabs along the bottom. And as we'll see a little bit later on, all the content in one sheet will transpose over in various forms to other sheets in the series, so that at the end of the day, we can click on a profit and loss projection that's based on sales information and then developed from a cash flow forecast. So all these different aspects of these financial models I'll explain as we go through, and we'll illustrate using some fairly easy, practical, easy to comprehend examples as we go through. First one I just quickly want to have a look at, which is a little bit of an adjunct to the others in the series, but this is just out of interest. Have you ever amazed or been amazed at what rate tradespeople charge when they come to dig a hole in your backyard or put up a wall or fix your roof or whatever? So if you're in a service type business, we often see people, particularly at startup, who don't value their own time. They don't charge enough. They don't know what they're worth. But very quickly, if you just wanted to earn something like the average wage in Australia, which is something like $80,000 a year, By the time you add in associated costs like tax, superannuation, insurance, workers' comp and so on, that could be as much as 30%, which you might need to add on to that to get an idea of how much gross you need to earn if you can net back down to 80,000. Then, of course, it's how productive you are or how many hours, how many billable hours you might have. So what are we thinking? We work about 48 or 50 hours a year, 40-hour week. What's that, 2,000 hours, is it? Well, probably not by the time you take out annual leave and days off and public holidays and the odd game of golf here or there, if you can fit that in. You might work 1,500 hours in the year, turn up for work. But unfortunately, not all of those are billable. You might be having meetings, you might be doing quotations, you might be sitting on the toilet, you could be doing all sorts of things. And in reality, to get something like 1,100 billable hours in a year where you're actually invoicing clients that amount is a fairly reasonable effort. And those of you that might have worked in professional practice in commercial businesses are possibly familiar with the concept of billable hours, and the budgets around that could be as little as 30 or so billable hours a week for many organisations. So there's around that 1,500 number that we were talking about. So if you want to make 80,000, already you're at $92.44 an hour. But at this stage, we haven't actually made a profit in the business at this stage. We haven't paid the overheads like rent or computers or insurances or taking a client out for a cup of coffee even. So if you say your overheads could be as much as 30%, these are hypothetical numbers, by the way. There's no rhyme nor reason to these, it's just to illustrate. But you could need to add on maybe another 30 grand or so to cover those sort of overheads, which adds another $27 odd to our billable total. But still, the business is now in, if you like, a break-even position. There's no reinvestment in capital, in new equipment or anything. So if you need to make a profit to be able to expand and grow, that might be another 20 or so percent. All up, we're at $144 an hour under that scenario. So next time a tradie comes around and they're charging $110, $120, $130 an hour and you think, well, I'm being ripped off, they're probably only trying to make something around the average wage. So again, not prescriptive, illustrative only, but probably food for thought. So I'll park that idea there for now and move on to our restaurant scenario, if I may. And I just want to get my resource here alongside me up to speed. And I'll come back here to our spreadsheet. So I'm going to click on this first tab, Sales Forecast Information. And what we're trying to do here is for your business or your business idea, think of the ways that you add value to your clients and how you get paid. What do you get paid for? What are the revenue streams, the ways that you can monetize the value that you're adding? In the case of our cafe, which goes by the name of My Cafe, we've got 3 revenue streams, just to keep it simple. We've got meal service, as the name might suggest, this is food. We've got beverage sales, okay, fair enough, we'll get that. And they also do some off-site catering, so maybe they do corporate lunches and that sort of thing as well in this cafe. So I think we can all fairly easily relate to that business. You can sort of see it. It's probably one of the ones on the corner down in the suburbs somewhere. I don't think it's in a Westfield or a place like that, but it's, you know, your suburban cafe. So what I wanted to just start with was our average sell price per unit. So if we're talking meal service, that could be a toastie, it could be a croissant of a morning, it could be a lasagna, chips and salad of an evening, it could be a pizza. So here's where we need to be a little bit creative and average in that category, try and come up with what we believe is a typical sell price. And I'm going to pick a number of $26. There's no rhyme nor reason to that, I've made it up, but it's probably on average, if you think of a cafe across the whole spectrum of trading from breakfast time through lunch, morning tea, afternoon tea, and perhaps dinner, $26 we'll go with. I've got a little template over on the side here, which is critically important at this stage, because what we're trying to establish here is something called our COGS, cost of goods sold or cost of sales, which are terms that you might have heard. of previously. And what this concept is, it's trying to capture the direct variable costs that are incurred in producing that product for sale. So we're not talking about the overheads, we're not talking about the rent and the insurance and the power bill and those sort of things. We're talking about the direct costs associated with providing that meal. It's typically materials, or in this case, ingredients. It may also have some consumables, things that are used up in the process, things like perhaps cooking oils or rubber gloves or disposable plates or napkins or something like that. So we've said $5 or $6 to buy, maybe if this is a pizza, they're probably making their own pizza dough, so it's a little bit of flour, a little bit of water, a little bit of yeast, salt, not much cost in that. A couple of dollars for the toppings, maybe a box that it goes in, something like that. You can also have other categories in various situations where you might incorporate direct labour cost. If you had staff who were only doing that particular job, you may say that, well, their cost is only incurred in providing that service or making that product. So you may want to capture their direct labour costs there. But as we'll see a little bit later on in the cash flow forecast, there's a spot for wages as an overhead as well. So as long as it's captured in one place or the other correctly and you understand where it's gone for management accounting purposes, you should be fine. So in this case though, we'll keep it fairly simple and we add those two together and we've got $8.30 as the cost to us directly in providing that meal service. As I said, that probably doesn't include wait staff who are doing all sorts of things all night, the cleaning staff, management. It probably doesn't include all those other overheads either. So that's about 1/3 of the revenue that we receive is already gone by the time the money's in the till. By the time the customer pays, we've already spent at least $8.30, haven't we? Because that's what it's cost us to directly make that product available for sale. That's an important concept because that's our cost of goods or our cost of goods sold, and when we take that away from our revenue, we're left with a concept called gross profit. And you might have heard of terms like gross profit and net profit, gross profit margin, gross profit ratio. That's what we're referring to. The amount of money out of every dollar of revenue that comes into the business that's left after we've paid our direct costs. And when you think it through further, from that gross profit, we've got to pay all the overheads of the business, and hopefully there's something left over, which is our net profit. Then all we've got to do is pay tax on that. So the next thing that we need to do for each of our revenue streams in the business model is to quickly look at how many things we're going to sell each month. Now, for a business that's been trading for some time, you'll know these numbers. You can project off your history. For a new business starting up, this is difficult. And a lot of people say to me when we're doing our training and this, well, I don't know how many widgets I'm going to sell. If I knew that, I'd win the lotto next week. Well, that's probably true, but let's turn it around and say, well, how many do you want to sell or how many do you need to sell? And if you're basing your estimates on a true market need, on value that you're providing to your customers, all you've got to do is get out there and sell them. Do your marketing, do your social media, have a website, go to your networking events, do your advertising, publicity, public relations, do all those tasks that you need to do in your marketing plan to make this happen. So I'm going to say that in our first month here, we might do 800. And then we're going to have a bit of a growth spurt. So it's important here that we just, whoops, wrong location, pardon me. 850. It's important here that we don't just drag that number the whole way along and assume that we're going to have very, very even sales month by month by month. I've been in my businesses for the best part of 30 years and I can't ever remember 2 consecutive months where sales were identical. It varies all over the place. And this is why cash flow forecasting and understanding cash flow itself, the timing of money in, the timing of money out, this is why a lot of businesses can get into trouble because we don't accurately understand where there are going to be holes in our revenue, where there's going to be excess of expenditure and where we might be caught short. So continuing this along, we might do 975. And you might think, oh, that's a big number. 4 weeks in a month, about 1,000, that's 250 meals a month. 5 days, that's 50 meal services. So you might do 30 covers at dinner time, 15 breakfasts and 5 or 6 through the day. That's pretty doable when you break it down to that sort of level. November we might crack 1,000, we might get busy coming into Christmas, 1,200 in December. What happens in January? Maybe you're a holiday destination and it's super busy. Maybe everyone goes away on holidays from your area. If you're in the CBD, all the businesses might be on holidays and business might be dead. So that'll be very much a local thing. What we often see in February though, that's when the credit card starts to bite all the consumers and people are back at school and back in their routine and back at work, and discretionary expenditure quite often goes out the window. So February is often a fairly slow month in retail. So we might reflect that in our numbers. And then we're back on our growth curve and we might, whoops, that could be 1,000. And we might end up doing 1,100 and 1,200 units by the end of the year. So there's our profile showing some growth, but some lumpiness and hills and hollows based on our activity. So if I just run forward to our cash flow forecast now, just very quickly, you can see that it's now starting to populate this cash in area. We've already, just in that one product, taken in over $300,000 in revenue across the year. So that's what, $6,000 a week, roughly, in food sales. So this is giving you an idea of what your revenue might be. It's cost us $100,000 to produce that food, according to the forecast. So let's go back and have a look now at another product, which is our beverage sales. And we might say, using exactly the same logic, and I'll just speed things up a little bit for the timing, it might be $12 per unit for a beverage. So that could be a glass of wine or a cocktail or a premium beer or a soft drink or a bottle of wine or whatever it happens to be. On average, it's a $12 sell. And again, we've gone through and tried to understand what our costs are, our direct costs for that particular product. Different cost for different products, as you might think. So we might go with $3.85 for every $12 of revenue. So again, that's about a third, isn't it? Or if it was $4, it would be exactly a third of the 12. And this is the reality for a lot of people in hospitality, in retail. Our cost of goods is quite often in that 25 to 40% range. Now, I don't know if you've ever thought about that, but every time you go to a cafe and you pay $100, they're only really getting 70 at best to cover all the overheads. So you might think there's a lot of money going in the till, but it's all accounted for. And it's important for us, as we model our own business, to understand the magnitude of those costs and what part of the process they fall in, so we can better manage our situation. So what I had done here, you might have seen that these have already populated. I've just said that on average, anyone that gets a meal, so up here, those 800 people, I've put in a little calculation that says the number we would sell is 3 drinks for every meal. Now, there might not be a direct causal correlation about that. It's not prescriptive, but on average, you'll be able to look at your figures and say, yeah, well, on average, we sell 3 times as many drinks as we do meals. So you can go through and work this out however you might want to, or forecast it, however accurately you want, but that's just what I've gone with here for now. And straight away too, we can go and see, if we look at our cash flow, that now we're up to $700,000 in revenue in this little business, because we've now sold beverages and food. So the last thing I wanted to have a look at, just to give you a feel for the different forms of revenue that might come into this sort of business. We've got off-site catering, and the assumption here is that it's for 30 or 35 people. So if you get a feel for what that might look like, maybe some hot food, maybe some sandwiches, wraps, slices, fruit platters, that sort of thing. Maybe for 30-odd people, what could that be? Like a staff meeting or a monthly meeting of production team, or a board meeting, or something along the pretty big board, 35 people. I don't know that would work too well, but anyway, we'll say 35 people is the average. So that might be a cost on average of about $875 to cater for that number of people. What is it, about $10, $20, $22, $25 a head, something like that. And we might be able to look at our costs for that. The food that we're producing, we might need a few boxes or cartons or hampers or something to deliver it in. We might engage Uber Eats or some direct labour component to do that delivery for us. So in that case, we only pay them by virtue of the fact that we're doing these jobs. If we don't do these jobs, we don't incur that cost. So they would be classified as a direct or a variable cost associated with generating this revenue. So the last thing we need to do is put in some numbers here. And I'll just look at my notes. We might go with, say, a dozen a month, so 2 or 3 a week. And that might increase gradually through the year as our Facebook marketing grows and our reputation grows a little bit. We might do 18. Coming into November, December, it might get busy for Christmas. It might be a real big part of what we do, but everyone's on holidays in January, so not much going on there. Similarly, February is fairly slow. Then we get back up to some reasonable numbers. And of course, you've got the flexibility to play around with this, to look at different scenarios and say, well, what happens if I double what I'm doing there? I didn't put that cost in. 221.25, pardon me. So what might happen if we sell more in March, April, May? What does that do to our profit? And we'll see that in a moment. The other thing that this spreadsheet will help us contemplate, do we actually get paid on the day when we do jobs? So obviously in the cafe, people come in and they pay for their food, their beverages and so on, but maybe corporates don't. So maybe we've got to offer them some credit terms, which could be, say, 2 weeks. I know here, anyone that deals with the business centre, our accounting department does the pay run and does all the creditor payments every fortnight. And if you want to get paid earlier than that, well, maybe you can do that through negotiation, but the standard is every fortnight. So sometimes if you deal with other businesses, you've got to fit in around their trading terms. And you might not want to offer trading terms, but that might be the reality of doing this sort of work. Good thing is we can factor that in, and what we'll now see when we have a look at the cash flow is we've got a line here which is revenue on credit sales. So we're saying that we're probably not going to get all the money that's due in the month that the goods were sold. There might be some carryover into the next and subsequent months. That's presuming, of course, everyone pays on time. So we've now introduced a concept of revenue that's come in by being offered on credit. And some of us might have had this experience in our lives in business. Not every dollar that you ever issue on credit ends up finding its way into your bank balance. There's any number of reasons why that can happen, but the longer you offer credit, the more extended the terms are and the higher the amounts, the more risk there is that you'll never see that money. So wherever you can minimise the amount of credit that you're offering and still do the business, from a cash flow point of view, certainly it's a very good thing to try and achieve. So if we just head back now to this first sheet, that's it completed as far as we're concerned. We've now effectively come up with our sales mix. We've got the different revenue streams and their direct costs, their revenues, and the amount of business that we're doing. You can now look at this and say, what have I got to do to serve 1,200 meals, 3,500 drinks, and deliver 40 boxes in the month of December? Have I got the resources in place to do that? So now you can use this sort of tool to look into your business and do rostering and staffing levels, recruitment maybe, hiring subcontractors to take a surge. So it's more than just a financial tool. This can help you in planning all aspects of your business. Let's move on to the cash flow forecast. So we've now populated the cash in, and we've got 800 odd thousand coming in with cost of goods of 280 odd thousand. So that's probably real. It's about a third. So most cafe and restaurant type businesses would think that around about a third of their revenue would go directly on providing the protein and the fruit and veggies and everything else that's consumed in the provision of those services. That's leaving a gross profit of $500,000. You think, wow, this is pretty good. But we haven't filled out anything down here. Accounting fees, advertising, buying assets, bank charges, consultancy, freight, rent, interest, motor vehicle expenses, merchant fees. What are all these things? So if we're doing a cash flow forecast and trying to do it accurately, we probably need to look into our files and see what do we normally spend on each of these things, or what would I expect to be spending on each one of these items throughout the course of a year. So let's quickly go through, and I'll try and speed this up for the sake of time, but maybe your accounting fees. This will depend so much on businesses individually. Do you have a bookkeeper? Do you do your bookkeeping yourself? Do you subscribe to Xero or MyOb? Do you give a shoebox full of your receipts to your accountant and let them do it all for you? No right or wrong, but what is your situation? So try and accurately reflect what it's going to cost you to do that. I think I put in here that one of these months, which might be, say, February, we might go to the accountant and get some help preparing the BAS, so there might be a couple of $100 extra there, and perhaps maybe around there as well, getting some support to lodge our compliance paperwork. What about advertising? So advertising and promotion takes many different forms. It could be a set amount that you pay for your social media advertising, or you might pay a graphic designer to do some work for you on your website, or whatever that might be. You might put an ad in the yellow pages, remember that, or the classifieds in the newspaper. Whatever your bent is, make sure you try and capture those costs there. You might need to buy some new equipment, perhaps a new machine or a new oven in our cafe, steam oven or something like that. Might be $20,000. So you can put that in there as an asset purchase. You might need to actually go and get a loan to do that. So we might need to get a loan for $20,000. That's money that's going to come in, but then we're going to spend it straight away. And if we go to a little principal and interest calculator here that I knocked up previously, we can see that over, say, 2 years, we can reduce our $20,000 down to zero by repaying around about $900 a month. And I've just picked an interest rate of 8.4%. I don't know how accurate that is today, but let's run with that. The interesting thing is that it's important to separate out the interest from the principal. So out of our $908, 110 of that is interest on average. We can claim that as a business tax deduction. So all of the money comes out of the cash flow, it all flows out, but part of it is a tax deduction, and the balance of it actually gets paid out of our after-tax income. So our profit after tax. So we can separate those numbers out to, say, 110 and maybe 800. So every month then we would have an interest charge, which is about there, of 110. And we pay that all year. And down here we'd have a loan repayment of, say, 800 in round figures. So unfortunately we won't get a tax deduction for paying the principal amount off that loan, only the interest component. The next one down, why don't we pay some electricity? What's a cafe pay for energy costs? A couple of grand, $2.5 grand, a quarter probably, something like that. Higher even. So maybe on a quarter by quarter basis, it might be 4,200 there. Maybe they've got a lot of candles light or something like that as well. Again, depending on all manner of things, everyone's individual circumstances will be different. So fill that out as best you can. Anticipate energy costs coming down, which I think we were promised, or perhaps going up. We're doing a forecast, so the more realistic we can make it, the better. We might pay our insurance, which is an interesting thing in itself. A restaurant-type business would probably have product liability insurance, public liability insurance, maybe general business cover, theft, break and enter, all those sort of things. You need to talk to your broker or your insurer, but maybe they pay 6 monthly $1,300-1,500 each time, something like that, or perhaps a whole lot more as well, depending on the extent of their cover. But let's put that in just to illustrate. We've got our interest figure. They've probably got some internet access. That might be, I don't know, $15 a month or something like that. Just copy that through. So here's the process. It's just a little bit more of the same, but just going through all of the categories of expenditure that you record now or that you might need to record, and try and forecast the timing of when those payments are going to occur. If you were just to average everything out over 12 months and not put down the actual month you're expecting to make the payment, then you would get the same net cash flow figure every month. And the reality is that if you've got cash flow coming in quite lumpy and then going out equally lumpy, where those two waves meet, they might cancel each other out. But if you've got a month where there's low revenue and high expenses, that might be a significant drain on your cash flow. You might go into overdraft on your trading account, or you might need to get extra funds into the business, a capital injection or something or other else. So that's where this becomes important, to try and get the timing of the cash flows lined up. Merchant fees, this is an interesting one. So unfortunately, with cash on the decline and electronic payments more the go, the reality is that we pay for our merchant fees to enable the transactions to occur. What I'm talking about is where there's a credit card payment, an online payment, anything other than cash or direct debit into our bank account. So in this case, I'm only going to make this up, but let's say, I'll put in a little formula here, that it's equal to half, 50% of the revenue that we get in, which is going to be that plus our wholesale, plus that, and all multiplied by, say, 2%. So what we've got, we're saying, of all the money that comes in, we'll get some in cash, some of it will be by direct debit, but the majority will be on credit card, or at least half of it on credit card or something like that. So of that half, we're going to get charged 2%. That's $500 odd a month. And that was a relatively slow month. So if we have a look at this in busier times, sometimes it's more than $1,000 a month that we're paying to the Commonwealth Bank for the privilege of using their EFTPOS machine. So thank you very much. It's the way that we get paid for doing our job. So, but it comes at a cost. There's 10 grand a year in bank fees. And they only made 8 billion. Sorry, I shouldn't go there. But that's why banks get rich and we don't. So banks make a lot of money. Let's not us offer credit to people. So when you're offering credit more than you need, whoever's on the benefit end of that credit is using you as their bank. I don't know about you, but I didn't make $8 billion last year. Let the banks finance them. Motor vehicle expenses, so we're doing deliveries, aren't we? Although I did say we probably were contracting this out to Uber, but even so, we're probably able to claim our motor vehicle. So we might have $250 or something like that in claimable fuel and other running costs each month, depending whether it's solely a business expense or it's partially a private expense. It would probably be tied into the level of trade that we did in the wholesale market, given that that's what we were using it for primarily. You could get down to that level of detail if you wanted to. We've probably got rego in insurance as well, probably $1,200 or something for rego and insurance. Maybe we're only using 50% of it, of the vehicle as a business deduction, and the rest is private. So in that situation, obviously, if you're only using a private vehicle partially for business purposes, you can't claim all of its running expenses and fuel and everything, but you can claim a reasonable portion as determined by one of a number of methods that the tax office enable you to use. You might do some repairs and maintenance as well. Let's put in a couple of services through the year. Seems to be a lot of money going out of this 800 or 900,000, doesn't there? Anyway. We've got some office expenses. You know, love going to Officeworks and buying up big, $25 a month maybe, something like that. One of the major costs that businesses have, particularly those who are in bricks and mortar locations is paying the rent. So if you don't own the premise yourself and you've got to pay commercial rents, what have I got there, $60-something thousand, including outgoings. That's pretty cheap rent for a cafe. In this industry, if you can keep your occupancy costs lower than 10% of your turnover, that's a site that's been well managed. You're operating at about the potential of the site. Anything less than 10%, you're banking money. Anything more than 10%, you're paying too much for a site that you're not realising the opportunity from. So it's one of the three main areas: cost of goods, wages, and rent are the three main areas of expense for a bricks and mortar business in this industry. So any dollar that you can save there, although it's difficult, that can really impact on your bottom line. Everyone's got to do some repairs and maintenance, maybe a couple of $100 every so often, maybe every quarter you might do. Whoops, not 3,000. And you might not know exactly when you're going to be spending that money, but use this as a budgeting tool. Yes, I plan to spend that money before June 30, or I plan to do that just after Christmas in the holidays. And that way it can be highlighted in your cash flow forecast, so you can expect that money will be leaving the bank account at that point. Maybe you're a member of a professional association and your subscription becomes due third month, September or thereabouts. Superannuation is next on our list. I might just leave that for a minute and duck down to, what else we have? Mobile phone, do that first. Say $100 a month or something for a mobile phone. Maybe you've got a couple of them. Your telecommunications might be a whole lot more than that, particularly if you bundle in maybe web and internet access and something or other else. But let's say there's no travel expenses for now, but wages. Wages is another major cost centre for most businesses, but particularly businesses in retail and hospitality. Of that $100 of revenue that comes in, typically you'll see something between probably low 30s to mid to high 40s. So 35, 37, 42% of that $100 spent on wages. Hopefully some of that goes to the owner of the business as well and not just staff. But that's quite real. So I might split the difference here and say that that number there equals, say, 37%, so 0.37 times our revenue, which is that plus that. So 37% of the sum of our revenue each month, and 20 grand, 5 grand a week. So for a little cafe doing those sort of numbers, that's probably a chef, a sous chef, or a head chef and an assistant, and maybe a couple of permanent front of house people and a few casuals. You'll easily get to 5 grand in wages, and probably a whole lot more. And that's keeping it to, well, 37% of that revenue, which it's difficult to achieve that in this day and age with penalty rates and our base rate as well. Then we haven't left it alone yet. We've got to go back up to superannuation. Now, we know superannuation's already at 11%. We've also got other on-costs associated with employment, like workers' comp insurance and the like. So I'm going to round this out to say about 0.15 or 15% of whatever we're paying directly in wages is possibly a fair estimate of our superannuation and other on-cost expense. There's $50,000 a year over and above the wages that we pay people for their entitlement and their sick benefits and everything else. It's neither good nor bad. If you're an employee, it's a great thing. As a business owner, it's just another thing that we need to be mindful of and budget for and make sure we're covering in our pricing. Okay, so almost done here. For this, probably just one more thing to have a look at. We've put in our loan repayments from earlier. That's the principal being repaid. Then there's a whole lot of other calculations that are happening down here towards the bottom part of this spreadsheet. One of the first things is that it summarises the total amount of money flowing out each month. So 32, 55, 41, 49. So it's not even at all, is it? It's up and down all over the place. And for those of us that might have operated businesses like this is very real. Some months you just wonder where the money's coming from. And you think, it was only so much last month. Well, when you have a look at it, you can see why it varies so much. Conversely, and perhaps appropriately, the revenue that's coming in varies as well. And I guess a good thing, a natural hedge that's built into this is the fact that those variable costs, the direct costs, actually go up and down with level of sales activity. If you're not selling as many meals, you're not buying as much stock. So there's a bit of a correlation there. But as for the rest of these things, these overheads, they need to be paid regardless of whether you even open the doors, let alone have a busy month. Another thing that's already calculated for us here is an idea of how much tax we might need to pay based on our net trading activities that month. And I'll show you in a minute how we've figured that out. It's for a particular circumstance, such as a sole trader operating this business, which may or may not be the case in a vast majority of businesses, but this is a training tool that we use specifically around startups, many of whom are sole traders. So another thing that this calculates for us, and will all come out in the wash in a moment, is the net GST liability each month. So this presumes that all of the inputs and all of the outputs of this particular business attract the GST. And in a restaurant, that clearly isn't the case when you think of it. Any fresh food that they buy in, there'll be no GST in a lot of that. Pretty much everything they sell will have GST on it, but not necessarily all of the inputs. So we've probably, in reality, overstated a little bit of the input tax credit that we would get back into the business. So you'd need to be mindful of that at the end of the day and make some adjustments for. What this then does, in consideration of what the GST liability might be, what the tax liability might be, it ends up being able to tell us what our closing bank balance is. So just let's understand that this is forecasting based on our sales activity and our issues around tax, GST, the timing of other payments in and out, how much money we're likely to have in this business's bank account at the end of every month for the next year. That'd be handy information to know, I would think, in the majority of cases. You'll be able to see, for example, have I got enough money to buy that new Ferrari, or to go on holidays, or to take the kids to Disneyland, or whatever. The sad situation in this case is, looking at it, we don't really. We only have a covering costs, $7,000, $8,000, $9,000 in the bank, and in fact here for a couple of months we even go negative. That's actually minus $8,000. So we're in overdraft for these few months here towards the back end of the year. We might need to put in some money ourselves into the bank account. Let's put in $10,000 of capital, and we'll be able to see now that we remain positive territory all year. So we need to put in some seed capital, a float into our bank account, if you like, to make sure that we've got enough money in there to cover all those negative cash flow months as and when they fall due. So I just want to flick forward quickly to the next sheet here, which is the profit and loss, and very quickly give you a summary of what this tells us. The first thing to note is that this, of course, is GST exclusive now. So the cash flow included GST, the GST that we collected from our customers and the GST that we paid to our suppliers, which we were later going to get back as input tax credits, but that's all included in cash flow. Cash flow is a completely separate concept to profit. So just because you've got positive cash flow or negative cash flow doesn't necessarily mean that you're profitable. There's a fairly tight correlation, but clearly the collection of GST is one example. That money goes into your business bank account, but it's not yours. Never was. You're just collecting it for somebody else. So if we now have a look at the P&L, it's GST exclusive. So these figures here are our cash, our revenue, not the money that we collected for the government. Likewise, our expenses are the true amounts that we paid, not the extra bit that we were charged in GST by our providers. So all those things are now taken care of, and at the end of the day it looks like we've made a profit. So let's go through that again quickly. Revenue in 830,000, with a cost of goods of just over $250,000 to give us a gross profit of just under 600,000. But look at our expenses in the business. They're around 500,000. So when you take that away, you're left with 70 or thereabouts. So for a business that's turning over something close to $1 million a year, they make about 7 or 8% net. And I'd reckon that across the scheme of things, that's probably par for the course. There's better, there's worse, but that's where the money goes. So it's interesting just to see that all that money comes into the till, and yet a good amount of it is already accounted for before the till drawer is even closed, before they've even finished tapping on the FPOS machine. And then we've got to make provision for paying all of these other things that are going to come up through the year to leave this sort of margin. As I said before, we've got a little tax calculator down here that works out the tax on $66,000 under the current tax scales as they were middle of last year. They're changing again 1st of July this year to something slightly different. The brackets are expanding and a couple of the rates are coming down. But that'll be published, and we'll update these presently. But for now, at least, on $66,000, your tax liability would be something around $12,000 as a sole trader. So I just want to make that distinction. If this business was operating as a sole trader, I don't know that you would necessarily operate a $1 million a year cafe as a sole trader, but you can. You might have a different structure in place, like a company and or a trust, or it could be a partnership or something. But in this case, we're presuming that the owner has to pay tax on that $66,000, and a further assumption is that they've got no other income, so they're paying from zero, so they're claiming the tax-free threshold. So these are our tax brackets as they stand, up to 18,000. There's no tax on that. The next portion, there's $5,000 up to 45,000. So between 66 and 45, the last of that money is in this middle bracket, which is currently taxed at 32.5%. So all up, there's a total tax bill when you add those three amounts together of just over $12,000. When we express that $12,000 as a percentage of the turnover that generated it, back here on the cash flow, we've got a figure of 1.45%. That's what's used to calculate our tax liability on that cash flow sheet. So one other thing just to take away from the P&L, of that $66,000, we've got a concept called coverage. What do we got to cover in that? Obviously the tax, and we've only got $7,500 of that tax there. The rest is due and payable at the next BAS period in a couple of months. So it'll be on the balance sheet as a liability. But out of that 66, we've certainly got to pay, or we have already paid 7,000. We've repaid part of the loan, so that comes out of that 66. And had we taken any drawings or purchased items of capital, they would have been included in that as well. So overall, there's, of that 66,000, there's 16,000 probably plus the next little bit of tax. So about 20,000 of that is accounted for. So the true money left back to the business is somewhat less than that. We can then construct a very quick mock-up of a balance sheet. This isn't a true balance sheet, it's just to illustrate what some of the concepts are. So a balance sheet is simply a statement at a given day, or a given period in time, as to the net equity or ownership of the owners of the assets of the business. So we've got assets such as cash and receivables, so the money that those people still owe us for the credit that we offered. Add those together and we've got an asset base of around about $23,000. However, we owe the tax office some money in respect of the last quarter of trading, and we also we had a loan which needs to be put in, so I need to go back and have a look at that, don't we? So up here we said that we had $20,000 that we borrowed, but we've repaid a portion of that in this first year. We started paying in the second month, if you notice. So after 11 months, what would the balance have been? So if we come over to this principal and interest calculator that we worked out, there's 11,248 that is still due and payable at the end of that 11th month, which is the end of our year. So 11,248 needs to go onto our balance sheet somewhere here as a non-current liability. So that will appear there. So we've got total assets of $20,000 odd if you include the cash and the receivables. There's no mention here of things like assets, tangible assets that the business might own, like machinery and the like. We haven't delved into that at this stage. And likewise, there's no other liabilities like payroll liabilities and other things that we've taken care of, just the money that we owe to the tax office and the money that we owe to the bank for the loan. So when we put those together, you can actually see that in this year of trading, the business has depleted its asset base by a couple of $1,000s. It's delved into its reserves. So that's a very simple construct of a balance sheet just to show some of the key elements that are on it. And all of these spreadsheets now are linked together by the data that we've played around with. We can go into this now and, for example, if we remember what our profit figure was, 66,000, we can now go into our forecast and say, well, what happens if I do 1,500 every month for the last 5 months of the year? Simply doing that, everything else staying the same, given that our variable costs have increased appropriately. What's that done for our P&L? That's put 30 grand onto our bottom line, just doing that. So now we can go back and play with different trading scenarios, different cost of goods. What if I put my sell price up from 26 to 30? Now, I might get a small reduction in turnover. You know, that might put some people off. Let's say that goes down to 1,400. So what does that do? I put my price up, but some of the sales have fallen off as a result. What's my profit now? It was 97 a minute ago. That's been better. So maybe I should put my prices up if you're confident that that would be the impact. So now we've got a tool that we can play around with. We can do what-if scenarios. We can examine the impact in numbers, dollars, by various different management decisions that we make, i.e. pricing, buying better. What if I go back to my liquor supplier and say, mate, I can't afford this. Can I do a better price? Can I get a trade price? And they might say, yeah, look, we'll take 10% off. You can have all your booze for $3.50. What does that do with our P&L? We're 117 before, at 131 now. So going back to your liquor supplier and saying, I want a better deal, straight to your bottom line. And we can see the magnitude of all these courses of actions that we might want to put in place. So, there's probably one other thing that I'll just quickly show you here. We're able to calculate a break-even point. So in financial terms, what we're talking about here is that point at which we need our sales level to be at, that we've precisely covered all of our overheads for the year, plus the direct costs associated with generating that amount of sales. There's a very basic mathematical formula that says if you divide your total costs, your fixed costs, by your gross profit percentage, which is 71%. So if we divide that 591,000 by 0.7177, we'll get a number of $824,000. So that says to us that we're going to break even. We're going to cover all of our costs for the year when our sales get to $800,000. You can now go back to your cash flow and have a look and see when the sum total of that gets to that number. So I don't know if you can see down the bottom there, that's at 670,000 already then. So we're going to get to that 800 odd thousand number sometime between March and April, most likely. Now that's interesting. We're running this business and we're not actually going to start making money realistically until the last 3 months of the year. So obviously we need the break-even period to be as soon as we can, as short as we can. And if we haven't broken even by the end of the year, funnily enough, we'll probably be running at a loss by that point. So there's a few things which I hope have been able to demystify some of the, I guess, the trauma we all face when we're trying to have a look at our financials. It can be an exasperating experience, but I think if you wanted to muck around with planning your sales mix, planning your cash forecast, just getting an idea of when your expenses are going to be, you can then say, wow, I need to sell so much to make break even initially, to then make your profit objectives that you might have as an individual. How can I do that? Then we've got to put in place a marketing and promotional plan to drive the business to achieve those outcomes. Or it might even be that when you look at this, you know what, it's too hard. I don't think I can get that out of this marketplace. In which case I might need to move on or change tack and do something or other else. So I trust that you've found this little introductory excursion into finances of benefit. I hope most of us are still awake. It can be a little bit daunting, but if we break it down into bite-sized chunks, I'd like to think that we can now use some of the information here to help us run our business more effectively. So in closing, that brings this session to a close. We'd like to again acknowledge that this has been brought to us through Service New South Wales Business Connect program. And I'd like to thank everyone for their attention. Hope we got something useful out of tonight, and look forward to catching you next time. Thank you very much.